Hey everyone, this is Kirk here again at OptionAlpha.com, and in this video we're going to go through some defined risk options trade adjustments. Now, just as we did in the last video on straddles and strangles right here in track number 3, I'm going to cover the exact techniques and strategy we use to adjust trades with defined or capped risk profiles. So these would be things like credit spreads, iron condors, and calendar spreads. Now, it's important to consider that these option strategies already have limited risk, right? You're already buying and selling or have defined risk in these trades. And so even though the same overall techniques are the same and apply the same way as they do with the last video on straddles and strangles, you're going to be somewhat limited in the types of adjustments or the aggressiveness of the adjustments that you can make. And what it's mainly going to do is limit the ability to possibly turn all of these trades around and make them winners. You're going to be more focused on these types of trades on reducing risk, not necessarily on potentially making any money off of these trades, but again, in capping the amount of risk that you have in the position or reducing the amount of risk that you have in the position. Now, as always, the key points to remember about making adjustments are: don't move the losing side. Always take in a net credit. We never want to be adjusting trades and paying money to do so as option sellers. Recenter the trade whenever possible. And what that basically means is we want to acknowledge the fact that the stock has made a higher move or a lower move. And by making an adjustment, we try to recenter the stock and have the stock in the middle of our break-even points or our new break-even points whenever possible. And number 4, that kind of goes along with number 2, is we want to widen the break-even points, which is going to naturally happen as we take in a higher and higher credit. So before we get into some case studies, let's go through a couple examples here on how we can make these adjustments, just kind of the overall strategy and high picture and kind of like 10,000 foot view here. So when you're doing or dealing with credit spreads, for example, after selling a call credit spread above the market, so you'd sell, if the stock was trading at say 50 or something like that, the stock would be here, and stock's trading at say 50, you would sell, for example, let's say the 55 calls and buy the 60 calls or something like that. You'd be selling options above where the stock is trading. The question becomes, how do you adjust or hedge this type of trade? I mean, it's already a risk-defined trade. You've already sold one option, bought one option. You already have defined risk here, and you should be obviously entering this position with a small position size. So for simplicity's sake, let's assume that you sold a $1 wide spread for 20 cents at a $15 or 15% probability of being in the money. That's about a 15 delta on the short strike. So what we would do is look to adjust this trade when the short strike reaches a 30 delta. So again, if the stock starts here at $50, once our short strike on the call side reaches a 30 delta, we'd maybe look to adjust the trade. And again, that will factor in different time and volatility indicators into the fact that the stock may be rallying up a couple dollars or implied volatility may be rising, whatever the case is. But just to use a guidepost, we might look to adjust this trade once the stock reaches a 30 delta. Now, we've got video tutorials on adjustment triggers, so go ahead and look at that. We're not going to cover that here in this video. What you would end up doing if the stock did rally towards your call spread is you would sell a corresponding put spread on the other side of the market for an additional credit. So what you basically do is match up the width of the strikes, which is $1 in this case, and the number of contracts, and turn this thing into an iron condor with no additional risk in the trade. So again, what you're going to do is you're going to take that original call spread side. You're not going to touch that call spread side, but what you're going to do is you're going to add a put credit spread down below the market to turn this into an iron condor. Now, if you sold a $1 wide call spread and you did 3 of them, you would sell another $1 wide put spread and you would do 3 of them. So you make everything exactly the same. And if you do that, you take in no additional risk because the market can't be on both sides at expiration. So if you don't increase the risk in the trade, meaning keep the strike width the same, keep the number of contracts the same, all you're going to do by selling this additional put credit spread is reduce the risk in the trade. And again, another little thing that's really cool about this is that when you do this and create this new iron condor, it's going to help widen your break-even points by the amount of the credit that you received. And again, it will recenter the trade over where the stock is. So if the stock is now trading, let's say at 55 here, now you can see our new iron condor, which is in the dotted line, is kind of right centered around where the stock is trading. Originally, the stock might have been trading down here around 50, as we talked about earlier. So now the stock rallies higher. This new iron condor, which is a little bit taller, a little bit more narrow, is now a little bit more centered around where the